The 5 Rules for Successful Stock Investing, Morningstar's Guide to Building Wealth and Winning in the Market by Pat Dorsey. Pat Dorsey is a renowned stock analyst at a prestigious U.S. fund rating agency. With extensive professional experience in securities analysis, Dorsey introduces concepts and methods from value investment masters such as Graham and Buffett in this book. It helps investors quickly build a clear value investment analysis framework. After listening to this book, you will benefit greatly and quickly make money in the stock market by applying its principles directly to your investments. Next, I will break down this book into 4 parts. 1. The core concepts of value investing. 2. How to analyze a company's fundamentals. 3. How to value a company. 4. Investment points in critical industries. Part 1. The core concepts of value investing. Regarding stock investment, the right concepts and methods are crucial for success. Many investment methods are popular in the stock market, such as technical analysis, momentum investing, systematic trading, and quantitative investing. However, only some of these methods can help you make money in the long run. However, one method has stood the test of time over a century of stock market practice, proving to be effective in the long term: value investing. Graham founded value investing and has produced many outstanding investment masters in history, including Warren Buffett, who has adhered to and advocated value investing throughout his life. Value investing can be summarized in one sentence: buying stocks is buying companies. Value investing is about judging a company's value from an owner's perspective. Its investment logic is that stocks represent ownership in a company. If the company operates well and can continuously make money, its value will increase, and its stock price will naturally rise. Famous American fund manager Peter Lynch concluded that short-term stock prices may have nothing to do with company performance. Still, company performance and stock prices are 100% correlated in the long run, reflecting this relationship. So, how should one practice value investing? The author summarizes 5 principles. 1. Do your homework. 2. Look for companies with substantial competitive advantages. 3. Invest with a margin of safety by buying cheaply. 4. Hold long-term after buying. 5. Know when to sell. These 5 principles encompass the entire process of stock investment: buying, holding, and selling. First, before buying, you must do your homework and understand and research the investment target as thoroughly as possible. For example, study the annual reports of target companies and understand the industry and competitors' situations. Spending more time on thorough preparation can reduce the chances of making mistakes. Secondly, in stock selection, value investing involves buying companies with substantial competitive advantages. You look for companies with robust operational capabilities and sustainable development. At the same time, investment should have a margin of safety, meaning you should buy cheaply. We will elaborate on these 2 points in the second and third parts. After selecting stocks and buying, the principle of value investing is long-term holding. Investors should have a shareholder mindset, requiring sufficient patience and persistence, because realizing a company's value takes time. Finally, does long-term investment mean you can't sell stocks after buying them? Not necessarily. Stocks should be sold in 3 situations. 1. You realize you were wrong, and the company you bought is not good. 2. Significant changes occur, such as deterioration in the company's fundamentals or the stock price far exceeding its intrinsic value. 3. You find a better investment opportunity or need to adjust the portfolio due to the high proportion of a particular stock. According to the author, one should patiently hold the stock apart from these 3 situations. Part 2. How to analyze a company's fundamentals. Peter Lynch once said that buying stocks without researching the fundamentals is like playing cards without looking at your hand. The chances of making money are minimal. Many investors make the mistake of not examining the fundamentals and instead following stories, chasing concepts, and fantasizing about buying the next Facebook. However, the probability of this happening is extremely low. The author suggests that investors abandon these unrealistic goals and determine if a company is worth investing in through a comprehensive analysis of its fundamentals. Analyzing a company's fundamentals involves three aspects. 1. Analyzing the company's competitive advantages. 2. Analyzing the company's financial statements. 3. Analyzing the company's management and operational status. It may sound professional, so let's create a hypothetical scenario to help you understand. Suppose a friend opens a bakery and wants you to invest. How would you consider this? First, you would want to know how much capital the bakery needs, the market demand for its products, and whether it can genuinely attract customers. Next, you would consider the bakery's owners and the team's management capabilities and whether there are strong competitors. What makes this bakery better than its competitors? In essence, analyzing the fundamentals of a listed company is no different from considering an investment in a bakery, though it involves more complex content. But don't worry, we can simplify it by focusing on one principle. Look for companies with substantial competitive advantages. It means that we prioritize analyzing the competitive advantages of listed companies. How can we do this? There are 4 steps. 1. Evaluate the company's profitability. 2. Examine the sources of the company's profitability. 3. Analyze how long this profitability can be sustained. 4. Assess the industry conditions. Let's break down each step in detail. Step 1. Evaluate the company's profitability. A company may have some competitive advantage if it has historically been very profitable. To judge a company's profitability, consider 4 financial indicators: free cash flow, net profit margin, return on equity, ROE, and return on assets, ROA. Free cash flow is the operating cash flow minus capital expenditures. Simply put, it is the portion of revenue generated from operations that the company can freely use for dividends or stock buybacks. Warren Buffett places great importance on this indicator. If a company's free cash flow exceeds 5% of its sales revenue, it might be a money-making machine. Net profit margin is the percentage of net income relative to net revenue. A net profit margin consistently above 15% indicates good profitability. Return on equity, ROE, is the percentage of net income relative to shareholders' equity. Generally, if a company consistently achieves an ROE above 15% over many years, it indicates good value creation. Return on assets, ROA, is the percentage of net income relative to total assets. These 4 financial indicators can help you quickly screen stocks in investment practice. Many stock software applications have stock screening functions, and you can use these 4 indicators as screening criteria to find companies with or exceeding these benchmarks, quickly identifying companies that may have competitive advantages. Step 2. Examine the sources of the company's profitability. It involves understanding why the company is so profitable and examining its competitive advantages sources. A company's competitive advantages generally come from 5 sources. 1. Product differentiation means the company can offer products different from others, which competitors find hard to imitate. For example, Apple's products like the iPad, iPhone, and iPod have distinct differences in system design and user experience compared to similar products, forming Apple's competitive advantage. 2. Brand means a strong brand can occupy consumers' minds for a long time, enhancing their recognition and willingness to pay. Coca-Cola, Nike, and Mattel's competitive advantages come from solid branding. 3. Low cost means offering the same products and services at a lower price than competitors. Companies can achieve this through improved production processes or economies of scale. For example, Southwest Airlines in the U.S. uses cost-effective planes and offers high-standard services without unnecessary additions, reducing route costs by 25% compared to other airlines. This innovation transformed the U.S. aviation industry, and Southwest Airlines' stock price increased more than 200 times from 1980 to 2018. 1. High customer switching costs mean that once consumers use a company's products, it takes more work to work on other products, which is challenging due to high costs in terms of money or time. For example, a company that produces orthopedic medical devices sells artificial joints to hospitals. Surgeons must undergo training to implant these products, requiring significant time and effort. Different manufacturers' products often vary, meaning switching to another manufacturer's products would need retraining, increasing switching costs. Thus, hospitals are unlikely to switch orthopedic product suppliers easily. 2. High competitive barriers mean a company with exclusive rights, patents, or network effects can keep competitors at bay. Exclusive rights and patents are easy to understand. Network effects refer to situations where more users attract even more users, such as Amazon and Facebook. In the internet sector, network effects often lead to a winner-takes-all scenario. Step 3. Analyze how long the profitability can be sustained. In today's rapidly changing technological landscape, competitive advantages based on product technology differentiation are often relatively short-lived. However, competitive advantages formed through low-cost advantages, strong brands, high switching costs, and high competitive barriers are more enduring. For example, Mutai's competitive advantage is more enduring than a technology company in the electronics industry. Step 4. Assess the industry conditions. The attributes and development stage of the industry determines the company's growth potential. For example, some industries have a stable competitive landscape, leaving little room for newcomers. Other industries are still in intense competition, potentially producing dark horses. Additionally, some industries are increasing, giving companies strong momentum, while others have reached their growth ceiling, slowing down the companies within them. Part 3. Valuing a company. One common mistake investors need to pay more attention to is valuation. You need to know how much a company is worth to determine whether its current stock price is expensive or cheap and assess an investment's potential risk and return. The author warns investors not to rely on hoping someone else will buy their stock at a higher price. This greater fool game often makes you the last fool holding the stock. Therefore, even if you buy a good company's stock, you must consider whether the purchase price is reasonable, which requires valuing the company. There are two primary valuation methods. 1. Discounted cash flow. DCF. John Burr Williams, a famous investment theorist, stated in his 1938 book The Theory of Investment Value that the value of a stock equals the discounted value of the company's future cash flows. What is discounted cash flow? Simply put, it is discounting each future cash inflow the company earns to its present value and summing them up to determine the stock's intrinsic value. The size of the discount depends on two factors: the interest rate. Higher interest rates mean lower present values of future cash flows, and the time. The further in the future the cash flow, the less its present value. Accurately calculating a stock's intrinsic value can be complex. Even Warren Buffett admits he can only value a few stocks because understanding those companies is beyond his capability. The main reason is that the future cash flows a company can generate are highly uncertain. However, as Buffett says, a roughly correct estimate is better than a precisely wrong one in investing. We can start with a rough estimate based on the DCF principle. There are 3 key points. 1. Higher earnings lead to higher valuation. 2. Longer duration of earnings leads to higher valuation. 3. Lower future operational risk leads to higher valuation. In practice, we can use these 3 points to estimate a company's valuation roughly. Many stock software tools can help with more precise calculations. However, always apply a discount to the valuation result, known as setting a margin of safety. It helps avoid optimistic overvaluation. The author's firm, Morningstar, typically sets a 20% margin of safety for stable companies with substantial competitive advantages, i.e., an 80% valuation, and a 60% margin of safety for high-risk companies without competitive advantages, i.e., a 40% valuation. On average, a 60 to 70% margin of safety is appropriate for most companies. 2. Relative valuation metrics. Common relative valuation metrics include the price-to-earnings (PE) ratio, the price-to-book (PB) ratio, the price-to-sales (PS) ratio, and the PEG ratio. Here, we will mainly discuss the PE and PB ratios. The P/E ratio is calculated by dividing the stock price by earnings per share (EPS). For example, if a stock is priced at 50 and has an annual EPS of 2, its P/E ratio is 25. The P/E ratio can be used in two ways. 1. Compare it to the industry or market average P/E ratio. Generally, a low P/E ratio indicates that the stock is undervalued, but this is not absolute. Consider the company's risk, growth potential, and capital needs. High-growth companies should have higher P/E ratios, high-risk companies should have lower P/E ratios, and companies with high capital needs will also have lower P/E ratios. 2. Compare it to the stock's historical P/E ratio. If a company's P/E ratio is significantly lower than its historical average, investigate the possible reasons, as this might present an investment opportunity. The P/E ratio is intuitive and easy to calculate, making it suitable for companies with long, stable operating histories. However, it is less effective for young companies with uncertain prospects. Or the P/B ratio is calculated by dividing the stock price by the book value per share. It is suitable for capital-intensive industries with significant fixed assets and financial sectors. It is less effective for service industries and innovative companies. Generally, a P/B ratio between 1 and 2 is reasonable for capital-intensive industries and banking. However, many domestic banks have P/B ratios below 1 due to market concerns about asset quality. When using the P/B ratio, carefully examine the company's net assets. For example, if a company spends $1 billion to acquire another company with a book value of only $300 million, the extra $700 million is recorded as goodwill. This goodwill might be impaired or written off if the acquisition performs differently than expected. Therefore, goodwill comprising a large portion of net assets can distort the P/B ratio. Part 4: Key investment points in major industries. This section will discuss key investment points in significant industries as presented in the book. The author showcases Morningstar's industry research results, including research approaches and critical factors for 13 industries. Analyzing this content helps investors understand how different sectors create competitive advantages and how competitive advantage strategies work. Let's focus on 3 significant industries as examples. Pharmaceutical industry. The pharmaceutical industry is a sector where many bull stocks emerge. The core competitive strength in this industry lies in the ability to develop new drugs. Although new drug development is time-consuming, expensive, and risky, pharmaceutical companies without innovation capabilities have no long-term prospects. Therefore, choosing those with continuous R&D and innovation capabilities is crucial when investing in pharmaceutical companies. Additionally, the author suggests paying close attention to government healthcare policies when investing in the pharmaceutical industry. Medical insurance and drug policy changes can significantly impact the competitive landscape of the entire industry. Although this advice is based on research from the American pharmaceutical industry. For example, the centralized procurement bidding policy introduced by the government in 2018 led to a significant drop in bid-winning drug prices, causing market expectations of profound impacts on pharmaceutical companies' revenues. Consequently, pharmaceutical companies' stock prices generally substantially declined. Consumer goods industry. The consumer goods industry is another sector where many bull stocks exist. When evaluating the potential investment value of consumer goods companies, focus on 4 key characteristics. 1. Market share. Generally, companies with high market share are likelier to maintain their leading positions. 2. Free cash flow. Mature consumer goods companies often generate substantial free cash flow, which can be used for dividends or stock buybacks, making them stable investment targets. 3. Brand. Companies with solid brand influence, such as Coca-Cola, Pepsi, Nike, and Adidas, undoubtedly have a competitive advantage. 4. Innovation. Pay special attention to companies capable of continuous product innovation and those whose innovative products have a significant market share, like Apple and Gillette. Banking industry. The banking industry is essential in national and global economies and is highly regarded by investors. Warren Buffett's investment portfolio has long held many bank stocks. The banking business model is simple and divided into two main parts: obtaining funds from depositors or the capital market, lending them to borrowers to earn interest spreads, collecting various intermediary service fees. The core task in the banking industry is risk management, which can be summarized into three types: credit risk, liquidity risk, and interest rate risk. Successful banks have four characteristics. 1. Strong and stable capital base. This enhances their risk resistance capabilities. 2. Good returns on equity, ROE, and assets, ROA. A bank consistently achieving an ROE of 15% to 20% and an ROA of 1.2% to 1.4% indicates good profitability. 3. High management efficiency. This can be seen from the bank's operating expense ratio. Lower expense ratios indicate higher efficiency. 4. Substantial and diverse income sources. The price-to-book (PB) ratio is a helpful indicator when evaluating banks' valuations.